Now we're going to look at a cash budget for an organization. So we start with our cash balance, and then we have information about our cash receipts and our cash disbursements. And then it tells us that we have a policy to maintain a minimum cash balance of $50,000. So we're going to look at if we have to do any short-term borrowing to guarantee that we have our required ending cash balance. So we have information here. Our cash balance, it tells us at the beginning of November 1st is $75,000. Our cash receipts in November, $525,000, giving us total cash available of $60,000. Our total cash disbursements prior to financing are for our expenses here in November, $450,500. We know that our minimum cash balance needs to be $50,000. So our total cash needed for the month is $500,500. Our excess deficiency of cash before financing effects, so our cash available minus our total cash out, is $99,500. For financing, we don't need to do any borrowing during the month, and we have a repayment of a long-term note, it tells us, of $50,000. We also have interest of $500 for that note. So our total effects of financing here, and this is money out, so I'm going to put a negative in front of the sum. So our ending cash balance is our cash available minus our cash disbursements equals our cash available minus our cash disbursements plus our financing effects. So we have an ending cash balance of $99,000. That is our beginning cash balance for the month of December. December, we have cash receipts of $450,000. So we have total cash available of $549,000. Our cash disbursements in December are $550,000. Minimum cash we want to have on hand. So our total cash needed is $600,000. So our cash deficiency is $51,000. Therefore, we need to borrow $52,000. We have 0 in repayments due. We'll have $520 in interest. So our total effect of financing, and this is money coming in, add that together. Therefore, our ending cash balance at the end of December is going to be cash available minus cash disbursements plus our total effects of financing. The next example that we're going to look at is looking at strategy to make decisions about marketing expenses. So we have information about our marketing expenses, and we're a relatively new company, and we believe that our costs are going to increase over the next couple of months. And so we want to look at, we're going to develop a Excel spreadsheet here that can be used to generate a monthly budget for our marketing expenses. So we have our sales commission is our original sales commission amount of $120,000 times 1 plus our percent increase or decrease, so our change. And our percent change is our cost, we need parentheses, minus our original cost divided by the original cost. So with our sales commissions, we also need to factor in that our sales prices are going down. So times 1 plus our 5% change in sales. So we do that for a whole amount. So sales staff salaries, we have our original sales staff salaries times one plus our monthly increase in staff salaries. So then our change is our cost minus our original cost divided by the original cost. Telephone and mailing is a cost of $38,000, and we have an increase of 6%. When we've calculated all of the increase and percentage changes, the only thing we have left is this new furniture cost. And this is a new cost, so we're going to look at the depreciation for this new furniture using the straight line depreciation formula. So equals SLN, and we put parentheses. Then we want cost, comma, salvage, comma, life. So we come up here to our information, cost, comma, salvage, comma, life. Close our parentheses, and it will return what our depreciation expense is. That is 100% change. because we didn't have that expense before. So next we're told that there's a strain on available cash and we want to reduce our total budgeted cost to $350,000. We need to reduce our budget. We've done some research and we've decided that the only thing that they think they can give up are the telephone costs. So we want to look at a change in our telephone and mailing costs. So what do we need to change that cost to in order to keep our total budgeted cost to $350,000 or below? So we're going to use the goal seek function under what if to calculate that. And we want to set our total budget cost to a value of $350,000 by changing the telephone and mailing costs. Oh, that's right. So this tells us that instead of our planned 6% increase in telephone and mailing costs, we actually need to reduce them by 23.4% in order to make those projected costs of $350,000.